Okay, good morning, students. Good morning, Komal, Shubham, Ishan, Rajiv, Diksha, Bhumika, Sudhanshu, Harnoor, Kiran. Yes, good morning, everyone. Well, Ishan is asking a question, and it is related to our previous lecture, wherein he's questioning why is the remuneration of a High Court or a Supreme Court judge taxable under this head, even though they are not, there is no employer for them. Judiciary is supposed to be independent, and therefore there is no employer as such for the High Court and the Supreme Court judges. Well, this has something to do with the Constitution, Ishan. There is Article 125 and 221 of the Constitution of India, which deals with remuneration of these judges. Now, there was an interesting case of a justice, which came before the Supreme Court, Justice Devki Nandan, wherein it was argued that since there is no employer, where is the question of taxing the remuneration as salary? But then, after reading the articles, they concluded, the Honorable Supreme Court concluded that whatever the judges are receiving are in the nature of salary because of the articles of the Constitution that I have referred, and therefore taxable under this head. Well, as far as unrecognized provident fund is concerned, well, I'm going to deal with that. Okay. Well, Bhumika has a question with respect to arrears of salary. Bhumika, we are going to again deal with arrears when we deal with section 89. So don't worry about it. Even if you've not got what we've discussed in the earlier lecture, do not panic. We'll again deal with it. Oh yes, salary paid tax we are going to deal with in the subsequent lecture when we deal with perquisites. Again, do not worry. What is the meaning of insurgency? Well, sometimes, there is chaos around the border. There are insurgents, that is some terrorist activity whereby at the borders, there people come inside the border of the other nation, of the other country. That is insurgency. Okay, Wahida is asking regarding illustration 2 of the module, I suppose. Well, I'll check the module and I'll let you know what is the education allowance of the younger son. Well, Ishan, it is Article 125 and 221 of the Constitution, which deals with remuneration of judges. Okay, so what we have done in the last lecture, friends, what we have done is we have seen the charging provision, we saw the definition of salary, and we saw a few allowances wherein we saw allowances which are completely exempt, and some of them were completely taxable, fully taxable, and some of them, partly taxable and partly exempt. So we've dealt with allowances, we've dealt with allowances, we've also seen that salary is taxable on due or receipt basis. We saw one of the examples wherein we saw how due and receipt basis could have an impact on taxation of a person. And we also saw, grade pay, the concept of grade pay in the last lecture. So we did deal with allowances and the charging provision. Today, I wish to move to the retirement benefit. See, understand we are dealing with salary, which is inclusively defined. So when you look at the definition of the term salary, you'll realize that salary includes wages, annuity, pension. Now, annuity and pension is the retirement benefit. Gratuity again is a retirement benefit. We are talking of profit in lieu of salary, wherein there are a few exemptions that are provided where there is a termination of employment, modification in the terms of the employment. It is treated as profit in lieu of salary. And there are some exemptions available. Now, we go one by one. There are roughly 5 exemptions for retirement benefit. We deal with all 5 of them. And what we do is we also solve a few concept problems so that you understand how the exemption got to be worked out. If you remember, in the last lecture, we have dealt with the tree analogy. You have a tree and it bears fruit. Now, fruit would be your revenue income taxable under the Act. However, tree, if you chop off the tree and sell the tree itself, well, that is capital receipt. Ideally, capital receipts are not taxable under the Act. However, if there contains a specific provision to tax an item of capital receipt, well, it is taxable. So the first in line of the retirement benefit is gratuity. Now, when you look at gratuity, friends, understand it is something which flows from the employer to the employee. So if it is a gratuitous payment from somebody else, it is not covered by Section 1010 of the Act, or it would therefore not be covered under salaries and not taxable under Section 15. Only whatever flows from the employer to the employee pursuant to his long employment. Usually, gratuity is paid for the purposes of considerably long period served by the employee as a token of gratitude. I'll share a small anecdote with you, and then we'll move with the provision. What happens is there is a carpenter in one of the kingdom, and the king is very happy with the carpenter because he has beautiful skills, and he has made some beautiful palaces, because of which the face value of the kingdom has been lifted. Now the carpenter is growing old. He's more than 60 years of age, given more than 35 years of his service to the kingdom, and now he wishes to retire. Goes to the king and says, so my eyes are weak, and I don't have the strength and the vigor to continue as the carpenter and head carpenter, and I wish to resign and I wish to retire. And the king is very reluctant because he served the kingdom for so long. And king says, okay, I don't want you to retire, but even if you do, no, you have to fulfill my last wish, and that is make a last palace. And the carpenter is extremely reluctant, but then you cannot say no to the king, and therefore he has no option but to agree. He starts working on the last palace, and he's making that he does work, but he's very reluctant, and therefore the last palace that he makes is one of the bad pieces of architecture, one of the very poorly made palace, since it was his last and he was reluctant to make it. The entire work is complete, and the carpenter goes to the king, hands over the key, and tells him that this is the palace that I've made, and now please let me retire. Out of the gratitude that the king had for the carpenter, what he does, he hands over the keys back to the carpenter and says, this is the palace that we have made for you. And that's when the carpenter realizes that the shoddy work he did has come back to him, although it was a piece of gratitude from the king to the carpenter. Now, in the real world, well, this doesn't happen. There is no in-kind gratitude that is given. The gratuity is usually in terms of a lump sum payment at the time of retirement. What if gratuity is received during the course of retirement? During the course of employment. If it is received during the course of employment, well, it is taxable. What we are giving an exemption here is only at the time of retirement, when your source is cut off. So do you get the concept? Do you get the concept of gratuity? So yes, I understand. The carpenter made a fool out of himself because it was his last assignment and he did not complete it wholeheartedly. Now, as far as government employees are concerned, see, whenever we talk of government employees, all the retirement benefits to a government employee is exempt. Government employees, as if they are son-in-law of the government. Anything that is received by government employee or a state government employee, which is in the nature of death cum retirement gratuity, usually government pays within their rules set, and therefore there can be no manipulation. And since there is no manipulation as far as retirement benefit is concerned, entire 100% is exempt. Fairly logical enough. When a government employee receives any death cum retirement gratuity, it is within the framework, and therefore 100% exemption is granted for gratuity received by government employees under section 10(10)(1). Right? How do you remember 10(10)? Well, you see the clock here. It shows a time which is 10:10. Now, moving further, what about those employees who are not government employees or other employees? When it is non-governmental employees, they are classified into two categories. One is those employees who are covered by the Payment of Gratuities Act. There is a Payment of Gratuities Act that deals with, that mandates the employer to pay to the employee a gratuity if the employee has worked for more than 5 years. For at least 5 years, if an employee has worked for at least 5 years, gratuity has to be paid by the employer to the employee. Now, it's a mandatory condition, isn't it? So if it is mandatory, employer would be required to pay gratuity as per the Payment of Gratuities Act. Do you all agree? Isn't it? He'll have to pay adhering to what the conditions are laid in this particular act. And therefore, Income Tax Act also got to be in sync. So what Income Tax Act says, anything that is paid as per the Payment of Gratuities Act would be exempt in the hands of the employee. Employer making payment to the employee, as per the Payment of Gratuities Act, we call it as POGA, for the purposes of our lecture, Payment of Gratuities Act. If an employee is covered by POGA, well, we are going to exempt anything that is paid as per POGA. Now, which employer would be covered by POGA? Well, an employer who has more than 20 employees, he would be required to fulfill the conditions of POGA. What is exempt? So under section 4, subsection 2 of the POGA, gratuity is quantified. Now, gratuity is defined on a logic. See, who would you pay more? An employee who has worked for 30 years, an employee who has worked for, let's say, 5 years, 10 years. Who's going to get more gratuity? Well, of course, it is going to be the employee who has rendered more service to the employer. So therefore, gratuity, the quantification of gratuity would necessarily depend on the period of service of the employee. Higher the period, higher the gratuity. Lower the period, lower the gratuity. So if one would work more, well, he gets more of the gratuity. Then, how do you quantify? You say 15 days of salary, wages, 15 days of wages or salary for each completed year of service, for each year of service or part thereof. So it would be, if a particular person has worked for 30 years and let's say 10 days, 30 years of service would be taken for all the 30 years. He'll get 15 days of salary, right? So 450 days of salary is what he'll get, right? And this 15 days of salary is worked out on 26 working days of a month. So it is not exactly 1/2 of the month, but it is 15 by 26. So it is not half month salary, but it is 15 days salary worked out on 26 working days. We'll understand this by way of an example, but for the time being, understand it is not half month salary. It is not 50% salary. It is something more than that. You'll realize that 7.5% more than 50%, right? So 15 by 26 should come to 57%, some odd figure like that. Now, what are wages? So we are talking of pay 15 days wages. Now, what is wages? Again, defined under the POGA. So what it says, wages means all emoluments payable in cash, including the dearness allowance. Now, dearness allowance might form part of salary, might not form part of the retirement benefit. Irrespective of the fact, it does not form part of the retirement benefit, yet to be included in the definition of the term wages, but excluding bonus, commission, overtime wages, allowances, etc. So what for salary for the purposes of POGA is the basic plus the DA, whether or not it forms part of the retirement benefit. Are you getting this, friends? And now the last option that the last condition that the Payment of Gratuities Act lays down is that the maximum gratuity to an employee cannot exceed 20 lakhs. So maximum, it could exceed 20 lakhs, but then employer is not mandated to pay more than 20 lakhs. So usually for a highly paid employee, the gratuity amount could go beyond 20 lakhs. But then here, the mandate on the employer to pay to the employee is limited to 20 lakhs. So 15 days salary for each year of work based on 26 working days and the last drawn wages. Usually the last drawn wages are highest when a person is working for a considerable long period of time. We also saw yesterday in the grade pay, the last drawn salary would be the highest. There would always be an increment, and therefore 15 days salary would be based on the last drawn salary of that person. Now, so do you get the Payment of Gratuities Act and the condition regarding that? Okay, I don't see a lot of queries. Let's deal with the queries at the end of the provision. Going further, as far as those employees who are not covered by POGA, now who would be those employees if the employer is a small employer, employing less than 20 workers and did not opt for voluntarily, registering under the POGA? In that case, if the employee is not covered by POGA, he'll have to adhere to the conditions laid by the Income Tax Act. The Income Tax Act gives the exemption in that case. If you're covered by POGA, you go by what is the condition laid down in the POGA. However, if an employee is not covered by POGA, then he'll have to adhere to what the Income Tax Act has to say. So Income Tax Act says that in case an employee receives any gratuity on retirement or termination, or incapacitation or death of an employee. So look at this. This is all received at the time of termination or retirement of an employee. During the continuation of employment, everything is taxable, right? To the extent it does not exceed. Look at this. If it does not exceed, based on the completed year of service, it is there. The term is completed year of service for Payment of Gratuities Act or POGA. The term used was completed year of service or part thereof. So even if if an employee has worked for 30 years and 7 months, we are going to round it off to 31 years, right? However, if it is, let's say, 30 years and 5 months, in that case, we are going to round it down to 30 years. However, here, when an employee is not covered by POGA, 30 years and 7 months would mean 30 years. So we are dealing with only completed year of service. That is what the Income Tax Act has to say. Going further, he would be eligible for an exemption to the extent of 1/2 month salary. So it is 15 by 30 and not 15 by, based on average salary of last 10 months. So we are not talking of, last drawn salary here. We are talking of average salary of last 10 months. Then As far as the definition of the term salary is concerned, here salary would mean basic plus DA in terms of employment plus commission at a fixed percentage of turnover. So it is the default definition. If you remember, we discussed this yesterday when we discussed section 1013A, and I told you that this is something which is prescribed under the Income Tax Act, basic plus DA forming part of employment, and the fixed percentage of commission is something that comes out of the Supreme Court decision in Gestational Duplicators. Right. So, and therefore, the standard definition of salary would be the salary for the purposes of exemption under section 1010 in case of a non-POGA employee. And the maximum gratuity here is 20 lakhs. So, maximum what you can receive under, the payment of gratuity, that is 20 lakhs. It is in sync with the Income Tax Act here, which says that the maximum exemption that you could claim is 20 lakhs. However, there is a tiny difference between POGA and non-POGA. This 20 lakhs is an aggregate limit. It is aggregate limit for an employee to claim in respect of all gratuities received from all of the employers. So let's say a particular employee who's a non-POGA employee has received 10 lakh rupees from his previous employer as gratuity, and he receives 12 lakh rupees from the current employer. Now his total gratuity received is 22 lakhs. Well, what we are going to give him exempt is only to the extent of 20 lakhs. So for the current employer, he will get additional 10 lakh rupees of exemption and not the entire 12 lakh. However, covered by payment of gratuity, that the moment it was lesser than 20 lakhs, the entire 12 lakh rupees would be exempt. Right. So aggregate limit is only in respect of a non-POGA employee. Moving further. So if gratuity is received under section 1010(3), we have already discussed, only then the aggregate amount of exemption of gratuity received from all the employers shall not exceed 20 lakhs. So if it is, an employee covered by payment of gratuities at, 20 lakh rupees is per employer and not for all the employers taken together. Then gratuity received while continuation of service is not exempt. We have already dealt with this point. Completed year of service would include the year of service under the previous employer, right? So it might so happen that a particular person had worked with a previous employer for 20 years, did not get gratuity then. However, the current employer is giving him gratuity. In this case, even the period covered by the previous employment would also be considered. For 15 days period for each completed year of service would mean even the completed years under the previous employer. As far as the Payment of Gratuities Act is concerned, if it is a case of a seasonal employee, so there are, industries which are seasonal in nature. Like say, for instance, firecracker. Firecracker would not work throughout the year. Umbrellas, that industry would not work for throughout the year. If that be the case, 15 days is replaced by 7 days. So it is not 15 days of salary, but 7 days of salary for based on 26 days, for the month, and multiplied by the last drawn salary. So that is how you work out in case of a seasonal establishment. As far as piece rate employees are concerned, well, it is 15 days wages based on 3 years of average last drawn salary of last preceding 3 months. 3 months of average got to be computed, and 15 days of salary worked out on 26 days multiplied by average of 3 months. This is only with respect to those employees who are covered by POGA. So for seasonal establishment and piece rate, you got to consider them only if Payment of Gratuities Act is applicable. If it is not applicable, then you have got half month's salary that is prescribed under the Income Tax Act. Do you get this, friends, everybody? Now let's take it by way of an example. What we do is we just take an example and then we move further. Okay. See, look here. We just view with Rupee Limited and retires on 15/6/2022. So Keshav has retired on June 15th, 2022 after completion of 26 years and 8 months of service. Now, while we deal with the example, a lot of your queries would be resolved. Do not worry. For the time being, read the problem, be with me. So 26 years and 8 months, you have to deal with this information. If at all it is a case of an employee covered by Payment of Gratuities Act, what happens? This 26 years would be rounded to 27 years. So his employment would be considered to be 27 years and not 26 years. However, if he is not covered by Payment of Gratuities Act, well, this 26 years and 8 months would always be rounded down. So it would always be considered as 26 years only, and 1,000 per month. His dearness allowance is 30,000 rupees per month. The turnover achieved by him is 1,50,000 rupees per month. Well, he has got a bonus of 1,25,000 rupees per month. Now, why these? I have to calculate the exemption under the in respect of gratuity, and therefore, why would this information be relevant? This information would be relevant to find out the amount of salary, the last drawn salary, and the average of last 10 months, isn't it? And therefore, this information is relevant to me. Gratuity that is received by him, by Keshav, is 15 lakhs. What he has received is 15 lakh rupees of gratuity. The rate of commission, which is fixed, is 1%. 1% commission, isn't it? Fair enough. So 1% would be that of 1,50,000 per month, right? So what would he be eligible for? He would be eligible for 1,500 rupees of commission every month. Now, gratuity from previous employer. Now, the employer word is not seen. Gratuity from previous employer is 9,25,000 received in the year 95-96 and claimed as exempt. So he's already claimed it as exempt. And basic salary until March 22. See, read this as March 22. There's a typographical error. It is not March 2020, but it is March 2022. So up to March 22, his basic salary was only 35,000 as against 50,000, which was last drawn. Fair enough. So do you understand the problem? It says that Rupee Limited is covered by Payment of Gratuities Act. Rupee Limited is not covered by Payment of Gratuities Act. What would be the amount of exemption? And another information is given. He was employed as an officer with visa previously, right? See, just have a look at the problem. See, the rate of commission is 1%. 1% of 1,50,000 would not be 15,000. It would be 1,500 of this. 1,500 rupees per month. Okay. So tell me, first the amount taxable if the employee was covered by the Payment of Gratuities Act. The amount taxable and the amount exempt under Section 1010. Now I'll just show you the provision again. Let's go by the provision. Here we go. Okay. So what we have got is the basic salary. See, the condition is gratuity to be paid is 15 days wages for each completed year of service based on last drawn salary and 26 working days a month. Right. Now, therefore, I have got, my basic plus DA is 80,000 rupees. It is 80,000 rupees. Do you all agree? 50,000 per month of basic salary and dearness allowance is 30,000 rupees per month. The information given is 60% of it only forms part of the retirement benefit. But that has nothing to do with the Payment of Gratuity Act. Payment of Gratuity Act says whether the DA is forming part of salary or whether it is not forming part of the retirement benefit, irrespective of the fact, you have to take into account that DA, which is paid in cash to the employee. So 80,000 rupees entirely would be his last drawn salary, multiplied by 15 divided by 26. So we are going to pay him 15 days salary for all the completed year of service or part thereof. And therefore we have got 27 years. So this is what you have to compute. 80,000 multiplied by 15 divided by 26 multiplied by 27 years. So can you work it out? Can you tell me what is the amount? See, are you getting it, friends? Everybody? Why 80,000 and why not 40%? Well, why not 62,000? Why this is considered as 80,000 when Keshav is covered by Poga? And not we are not considering it this amount as 68,000. That is 50,000 plus 60% of 30,000. Okay, I see a lot of answers. So it is 12,46,154. Now what is he got? He has actually received 15 lakhs. See, gratuity would be exempt to the extent it is received. If this would have been worked out to, let's say, 17 lakhs, he would not have claimed a loss of 2 lakhs. Maximum exemption would be the amount of gratuity actually received or the amount exempt under, the amount paid as per the Payment of Gratuities Act or rupees 20 lakhs. That is the statutory limit. So 15 lakhs or 12,46,154 or rupees 20 lakhs, whichever is lower. So fantastic. It is indeed 12,46,154. So we'll go with that answer. So this is going to be exempt. What is taxable? Therefore, 6. Well, yes, Harnoor, very good. It reduces the amount of exemption. So the exemption would be less. Why? Because instead of 15 by 26, it says half month salary. And for each completed year of service, so it doesn't take into account part thereof. And therefore, it would be 1/2 into 26. And we are not talking of the last drawn salary, but we are talking of the average salary of last 10 months. So now you will have to compute the average salary of the last 10 months. See, if I were to calculate the average salary of the month of May, see the last month prior to the month of retirement was May 22. His salary with the standard definition of salary would be 50,000 rupees per month for the month of May, 50,000 rupees plus, dearness allowance is 30,000 rupees, out of which only 60% forms part of the salary. And therefore, only 18,000 rupees would be added, DA forming part of the salary. Plus, commission paid at a fixed percentage of turnover. Only this is added. If had it been commission at a flat rate, if the information given was commission paid to Keshav at the rate of rupees 5,000 per month, then we did not add 5,000 rupees over here. Why we are adding commission? Only because it is as a percentage of turnover achieved, which is 1,500. So this is for the month of May. Likewise, you will have to compute salary for each of the last preceding 10 months. So May, April, March, February, January. However, there's one more information that is given to us, and that information is that is salary have been scaled up from 35,000 rupees per month to 50,000 rupees per month from the month of April. So until April, so May and April 22, it is going to be this salary. 50,000 plus 18,000 plus 1,500. So it would be 69,500. For 2 months, it is 69,500. But for the period starting from March 22 until, August 21, that is remaining 8 months. Remaining 8 months, his salary would be 35,000 plus 18,000 plus 1,500. See, are you getting this? 35,000 plus 18,000 plus 1,500, which would be 54,500. Right, so my average salary is going to be 69,500 multiplied by 2 plus 54,500 multiplied by 8. I just got to work it out. So I'll just show you the solution. So simple, here it would mean basic plus DA plus commission at a fixed percentage of turnover for last 10 months. Add all of the last 10 months of salary divided by 10 so that you get average salary. Multiply it by 1/2 and multiply it by each completed year of service to get the maximum exemption. See, look here. So gratuity received during the year is 15 lakhs, less exempt under section 1010, 15 days salary for each completed year of service. For the first 2 months, for the last preceding 2 months, May and April, it is 68,000 rupees plus the commission. So 69,500. And for remaining 8 months, it is 53,000 plus 1,500 rupees of commission. Commission has remained constant over a period of time. And that is again 54,500. So 69,500 multiplied by 2 multiplied by 8, that gets us to 5,75,000 rupees of total salary in the preceding 10 months. All right, Rajiv, you're absolutely right. 5,75,000. The half month salary, therefore, would be 1/2 of 57,500. So that is my half month salary multiplied by 26 years, which brings us to 7,47,500 is the maximum amount that could be claimed as exempt. So it would be minimum of what? Minimum of 15 lakhs that is actually received. Sorry. 15 lakhs that is actually received, and the amount that we have computed based on half month salary, which is 7,47,500, and the maximum limit that which is prescribed, and that is 20 lakhs. But remember, one more information is given to us, that his previous employer has also paid him some gratuity, and he has claimed it as exempt to the tune of 9,25,000. So if he would have claimed it, to the extent of 9,25,000 earlier, the maximum exemption that he could claim, it would be 20 lakh rupees less 9,25,000. So the maximum exemption as per the monetary limit would be 10,75,000. Although the amount that we have computed is lesser than 10,75,000, and therefore we could claim only 7,47,500 as exempt, and the balance amount of 7,52,000 would be taxable. Do you get this, friends? Everybody? Okay, Darshan, what about the 15 days of June? Well, we are talking of preceding 10 months, and therefore we'll have to go by the month of May, So we are not considering the last 15 days of his service. It's the last 10 months. So this is something, unlike the leave encashment. In case of leave encashment, we are going to consider these 15 days also. Last 10 months. We're talking of last 10 months here. Darshan, I suppose your doubt is clarified. Okay, Avdesh, completed year in case of POGA employee would have been 27. However, non-POGA employee or those who are not covered by the Payment of Gratuities Act, it would be 26. We are not considering the part of the year. Well, Arshita, yes, we do not deduct this 9,25,000 out of the monetary limit prescribed under the Payment of Gratuities Act. This aggregate limit of 20 lakhs is provided only in case of non-POGA employee or those who are not covered by the Payment of Gratuities Act. You're absolutely right. Well, Sudhanshu, why only 60% have been considered here? The reason is we have to follow the standard definition provided by the Income Tax Act. See, you are not governed by the Payment of Gratuities Act, and therefore you have to abide by the definition of salary prescribed under the Income Tax Act. And what it says salary for the purposes of gratuity, computing gratuity would be basic plus DA forming part of the salary. So DA forming part is only 60%, and therefore we have considered only 60%. No, Mayur, we did not figure out what is taxable. While we work through all of this, we have figured out the amount of exemption. See, what is the amount of exemption? Amount of exemption is 1, 15 lakhs, 2, or 7,47,500, or 10,75,000, whichever is less. This is the amount of exemption. So out of 15 lakhs, we are going to exempt 7,47,500, meaning balance would be our taxable gratuity. We have not computed the amount of taxable gratuity by using this condition. We have found out the amount of exempt gratuity. I hope your doubt is clear, Mayur. Okay. Should we move further? Okay, Darshan, last question in respect of gratuity, and then I'll answer all the questions for gratuity after at the end of the lecture. Gratuity is exempt in case of both death or the retirement of the employee. Retirement would not mean retirement on superannuation alone, that is after the lapse of a particular age, but it would also mean termination. So whenever gratuity is paid to an employee at the time of leaving of the employment, that is going to be exempt under section 10(10). Moving further. So pension is one such item which is again, provided to an employee as a support from the employer after the employment, at the end of the employment, after the employer and employee relationship is over. So ideally, you would say why would this be taxable as salary? See, pension is paid to the employee only by virtue of an employment. Had he not been into the employment, he would not have got the pension. And therefore, specifically, pension is covered by the definition of term salary under section 17(1). And therefore, pension is part of the salary to be taxed. Pensions, you all would appreciate, is a periodical payment, monthly receipt, isn't it? If you would have had any relative who was in government service, retired out of the government service, they are usually in receipt of monthly pension. Now that monthly pension is going to be taxable. So whether he is a government employee, not a government employee, the uncommuted monthly pension is taxable. However, what is exempt? Exempt is if you take a lump sum, if you commute the pension. Let's say you are receiving 50,000 rupees per month as pension per month. Now what you say, I don't need 50,000. You go to the employer and tell him, boss, you pay me only 10,000 rupees and pay me a lump sum for the 40,000 I waive every month. My entitlement is 50,000. You pay me only 10,000. I am waiving off my right of 40,000 rupees of pension. You pay me some lump sum amount. The employer, depending on the age of the employee, etc., and other factors, what he says, okay, I'll pay you 10 lakh rupees upfront in lieu of this 40,000 rupees per month. And you agree to that fact. So this is where, what you have done is you've cut the tree. If you remember the tree analogy, you have cut the tree and sold it off. The source itself has been transferred. So you do not have the right, after receiving this 10 lakh rupees, you do not have the right to receive 50,000 rupees of periodical payment, but instead of that, what you're going to receive is only 10,000. Since it is a lump sum amount, I need to give you some exemption. It is a capital receipt in a way, and therefore I pay you some, I'll give you some exemption. What is that exemption? In case of a government employee who commutes his pension, so he takes a lump sum by surrendering his regular pension. If at all a government employee does something like this, the entire commuted pension is going to be exempt. So whatever he receives, let's say, he had received this 10 lakh rupees, the entire 10 lakh rupees received by the government employee would be exempt, because commutation would be allowed to that government employee only within the set rules of the government, and therefore it is exempt. So he could be a central government employee, state government employee, or an employee of a local authority, 100% exemption in respect of commuted value of the pension. However, if he is not a government employee, if he is not a government employee, look at this, it is here you've got an exemption which is very intelligently structured. Understand, there is no legal framework for the purposes of commutation of pension, and therefore Income Tax Act is the only source for providing exemption. Now, under the Income Tax Act, other employees have been categorized into two. One who is in receipt of gratuity. Now, if he is receiving gratuity, he already claims exemption under section 10(10). And two, one who is not in receipt of gratuity, not receiving gratuity. Now, the assessee who does not receive gratuity would claim no exemption under Section 1010. So, who should I give more benefit in respect of commutation of pension? One, who's received gratuity, or two, who has not received gratuity? Well, I'll give more exemption to the one who has not claimed benefit under Section 1010. Because, he has already claimed exemption for gratuity, and now again he's claiming exemption for commutation of pension. Let me reduce his exemption over here. So what they say, if an employee is receiving gratuity and he receives something out of commutation of pension, what is exempt is the commuted value of 1/3 of the pension. Whatever he commutes, we first find out the full value of commutation, and only 1/3 of the value is going to be exempt. For the timing, just understand that 1/3 is going to be exempt. We are going to take it by way of a problem, and you'll understand this completely. There is no problem, right? So commuted value to the extent of 1/3 of the total commuted value of the pension. In any other case, when he is not in receipt of gratuity, in that case, only 1/2 of the, in that case, not 1/3, but 1/2 would be exempt. So 1/3 is like 33.33% exemption. 1/2 would mean 50% exemption. So one who is not in receipt of gratuity gets a 50% exemption, and one who is receiving gratuity gets a 33% exemption. So this is fairly logical. Those who are receiving gratuity are already claiming exemption under Section 1010. Let's lower their exemption, therefore. Let me just take an example and you'll understand this pretty well. See here, we have got a problem, a concept problem. Mr. Dhoni retires on 15th of August at 7:20 hours, receiving pension of 50,000. So what is he receiving? He is receiving 50,000 rupees of pension, right? So what does he receive? He receives 50,000 rupees per month of pension from 15th of August. Since he retires since he had retired on 15th of August, he would receive pension from 15th of August. Now, on 1st of February, so until 31st of Jan, from 15th of August to 31st of Jan, how many months could somebody calculate? You calculate half of the month also. So from 15th of August to 31st of January, he would receive 50,000 rupees per month. Now from 1st of February, what he does, he commutes 60% of his pension and receives 30 lakhs. So here is going to commute, means what? Forgo how much? 60%. So meaning what? He'll take only 20,000 rupees per month, isn't it? 20,000 rupees per month from 1st of February. But for that foregone 30,000, what is he receiving? He is receiving 30 lakh rupees. Now, for the 60%, he has received 30 lakhs. What he would have received had he foregone entire, entire pension, entire 50,000. I know that I had foregone 60%, I've received 30 lakhs. For 60%, he has received 30 lakhs. What would be the amount? If he would have foregone 100%, how much would have been the amount? Well, you need to merely cross multiply, right? So 30 lakhs divided by 60 multiplied by 100. So that is going to give you how much? Just calculate somebody. Well, yes, Ishan, it is 5.5 months. Okay, Ishan says it is 5.5 months. For 5.5 months, he is going to receive 50,000 rupees per month as pension. Now, this pension is entirely taxable. because it is uncommuted. It is periodical and therefore entirely taxable. We get exemption only for the lump sum amount of rupees 30 lakhs. But then we have to figure out what would have been the amount of commuted pension had he surrendered entire uncommuted pension. So entire 50,000, if it was surrendered, he would have got 30 lakhs divided by 16 multiplied by 100. So if he would have no 50,000 divided by 0.6, sorry, 30 lakhs. So 50 lakhs he would have got if he would have surrendered the entire amount of pension. Very good. So yes, Darshan, Mayur, Sudhanshu, you're bang on right. Drishya, yes, 50 lakhs. Now let's come to the next part. Compute his taxable pension, assuming. So what is asked is the amount of taxable pension. Read the problem very carefully always. You know what is asked is taxable pension. Now taxable pension would be both a sum of commuted as well as uncommuted. So he is in receipt of uncommuted pension also. Do not forget to include this uncommuted value, right? So you are going to take into account uncommuted value at the rate of 50,000 per month into 5.5 months and 20,000 rupees per month for the month of February and March. That is for 2 months. This is going to be included. So uncommuted value plus the taxable commuted value. But for finding out the taxable commuted value, you'll have to first compute the exempt commuted value. So what is exempt? In case of government employee. What is exempt, friends, in case of government employee? In case of government employee, 100% exemption. So had Dhoni been a government employee, entire 30 lakh rupees would have been exempt. Now, if he is a private sector employee receiving gratuity, he has also received gratuity, right? And therefore, only 1/3 of the value is going to be exempt. My entire commuted value would be 50 lakhs. 50 lakhs ka 1/3. This is the amount of exemption if he is covered by the Payment of Gratuities Act. So 50 lakhs into 1/3, can somebody tell me what is the amount? And if he is not covered by the Payment of Gratuities Act, in that case, 1/2 of the commuted value. So 1/2 of the commuted value would be 25 lakhs if he is not covered by the Payment of Gratuities Act. This is the amount of exemption, and the balance. So what he has commuted? He has commuted 30 lakhs. What is the 1/2 of the commuted value? 25 lakhs. So 5 lakhs would be taxable if Dhoni is not in receipt of gratuity. Right? Do you get it, friends? Everybody? Somebody calculate 1/3 of 50 lakhs. Okay, 16 lakhs. 16 lakhs, 66,667 rupees of exemption out of the 30 lakh rupees that he has received. So balance would be taxable. So if he is in receipt of, gratuity, 1/3 of the full value of the commuted pension. And if he is not in receipt of gratuity, it is 1/2 of the full value of the commuted pension. Getting this, friends? How do you present it? Well, look at this. Here you have the solution. See, first and the foremost thing, you remember to compute the uncommuted pension. The uncommuted pension is going to be, for 5.5 months, 2,75,000 taxable in each of the case, whether he is a government employee, whether he is in receipt of gratuity, or whether he is not in receipt of gratuity. 40,000 rupees again taxable in all the cases. As far as the uncommuted value is concerned, it is uniform for all the employees, all kinds of employees. So 3,15,000 to be taxed as uncommuted pension. When it comes down to commuted pension, 30 lakh rupees in case of government employee entirely exempt. For if he was covered by the Payment of Gratuities Act, or he has claimed any exemption under section 1010, well, only 1/3 of the full value of the pension, commuted full value. And if he's not in receipt of gratuity, 1/2 of it. And that is the answer, right? So fantastic. Most of you have done it rightly. Yes, Rakshita, fantastic. Let's move further. So I hope you're getting this, the commutation of pension. Well, judges of the Supreme Court, High Court will be entitled to exemption on the commuted portion entirely, as if they are government employees. Now moving further, National Pension Scheme, the NPS. Okay, Mayur, the notes have already been shared. I don't know why you're not able to find it out. See, important, the National Pension Scheme, what happens here? There has been a shift in the pension scheme of the government employees. Earlier, it was the government who was paying pension to the employees under the old pension scheme. And now today, what happens is the government contributes 14% of the salary in a pension scheme, National Pension Scheme, NPS is what we call it. And a similar contribution is taken from the employee. Even the private sector employees could be part of the NPS. So private sector employer who contributes, let's say 10% of salary towards the pension plan, similar contribution is done by the employee. Now, what happens here? A particular employee might contribute an amount. So there are two components. One is the employer's contribution and two is the employee's contribution. Now the employer is contributing to this fund for the benefit of employee. Do you all agree? And therefore, this is considered as salary under section 17(1) VIII. This is salary, the employer's contribution. The employer's contribution is going to be salary, treated as salary, and therefore included in the amount of salary. But then this is a retirement benefit. I'm going to get the advantage of the contribution to NPS post-retirement, and you're collecting tax from me today in order to, give relief to the employees, because this amount is not going to be, disposable in the hands of the employee right away. They'll get the pension only at the end of the period, or like at the time of retirement. And therefore, in order to make this salary, rationalize the taxation of this salary, the employer's contribution is deductible under section 80 CCD subsection 2, 80 CCD 2. So this entire employer's contribution is exempt, is deductible under 80 CCD 2. As far as the employee contribution is concerned, well, employee's contribution is always done out of his taxable income. So like, let's assume a particular employee has got 10 lakh rupees of salary, right? And he contributes 1 lakh rupees towards NPS. So he is not going to, his entire salary is going to be 10 lakh rupees. Which pays towards NPS, what he gets in hand is only 9 lakh rupees of salary. So what happens is, look at the process, what the process is. I'll just show you the process. Let's go a little ahead, I will come back there. See what happens with all the funds, whether it is a Provident fund, whether it is a Superannuation fund, or whether it is the National Pension Scheme, NPS. What happens is there is a employee. This is an employee. He contributes one part of the contribution. The employer, he contributes one part of the contribution to the fund. right? So there are two parts which gets into the fund, right? One is the employer share and the other is the employee share. As far as the employer share is concerned, this is salary. This is some benefit, this is perquisite, or this is contribution for the welfare. This is ideally salary, because employee is going to get something more than what the basic amount. He's going to get something more, and therefore this is salary. As far as the employee's share is concerned, this is contributed always out of his disposable income, already taxed. So, and therefore this is not part of the salary. It is already been taxed. So again, I'm not going to tax the same amount. It goes into the fund. So it is not just the contribution that is paid to the employee, but also the interest that this fund is going to earn. The fund is going to, have a lot of money. And what the fund would do, the fund would invest. What the national pension scheme does, it would invest the amount that is contributed by the employer and the employee in the designated securities. And it would earn some amount, interest, profits, etc. And this interest or dividend or profit would again be distributed to the employee, right? Because it is employee's money at the end of it. So this is how the fund operates. Now going back to the NPS. In case of NPS, the employer's contribution is treated as salary. However, deduction is provided under 80CCD2 to the extent of 14% of salary. In case of government employee means both the state and the central government, and 10% of salary in case of other employees, right? But first and the foremost, what you got to do is include the amount of employer's contribution in the gross salary. So that is going to be first included in the salary, and thereafter only deduction would be given. Now this deduction is under chapter 6A. You will deal with this when you deal with deductions under chapter 6A subsequently, but for the time being, understand employer's contribution is part of the salary, whether it is 10%, 5%, 14%, 20%. The entire contribution of the employer becomes part of the salary. As far as the employee contribution is concerned, it is out of his disposable income. You don't have to consider anything out of it, right? So national pension scheme to be added. Salaries in the hands of the employee. Going further, retrenchment compensation. See, okay. Are you getting this, friends? Everybody, the NPS is, to a limited extent, you got to understand right now. As far as the deduction is concerned, it would be taken care of at a later stage. But for the time being, merely understand the employer's contribution to NPS is to be included in the salary. Retrenchment compensation deals with compensation to the employee by the employer pursuant to any dispute. Sometimes what happens is employer and employee are at dispute, and therefore a particular employee is retrenched or thrown out of the job. Now that employee would file a court case. He would file a case with under the Industrial Dispute Act with a labor commissioner or with the labor court. And he would say that, he would claim that the employer has not been justified in removing the employee from the job. And under the Industrial Dispute Act, there would be some award of the compensation. Now, this compensation is ideally for the services which have been terminated. So it is forceful termination that happens over here under section 1010B. It is a forceful termination, and because of the forceful termination, there is a dispute. And since there is a dispute, what happens is there would be an award by the court. And if at all such award is received by the employee, it is exempt to the extent of 5 lakh rupees. Up to 5 lakh rupees, an amount notified by the central government, maximum 5 lakh rupees of exemption you're going to get in respect of retrenchment compensation. So again, the tree analogy works here because it is a capital receipt 5 lakh rupees is the amount which is maximum allowed as exemption. However, it is also subjected to the period of service. So as far as the compensation is concerned, it is computed under section 25F clause B of the Industrial Dispute Act. Now, what does the Industrial Dispute Act say? If a particular employer works for a long period of time, he should get more compensation. If he has worked for, let's say, 1 year and immediately have got a dispute, what is the amount you have to pay as compensation? The employee would again search for a new job, right? So you don't pay too much of compensation there. But if at all a person has worked for a long period of time, you pay him 15 days of average pay. 15 days of average pay. Now, what is this average pay? Average pay here would mean 3 months salary. So unlike the Payment of Gratuities Act, under the Payment of Gratuities Act, we were talking of 10 months salary. However, here we are talking of 3 months salary for each completed year of service. So again, completed year of service to be rounded off, right? Or part thereof, therefore, completed year of service or part thereof. So above 6 months, if at all a employee has worked for 30 years and 7 months, it is above 6 months of period served, and therefore rounding off would be 31 years of service. So 15 days of average pay computed based on last 3 months salary, to be rounded off, the completed year to be rounded off, or rupees 5 lakhs, whichever is less. Now, 3 months salary got to be computed. And what is salary for the purposes of Industrial Disputes Act? Now, salary for the purposes of Industrial Disputes Act is the monthly amount paid to the workman, right? Monthly amount paid. Now, what that monthly amount would be? That monthly amount would be all remuneration. They are saying it is all remuneration, whether, being expressed in terms of money. So it could be valued as well, which includes DA, rent-free accommodation, leave travel concession. So everything but for the retrenchment compensation, right? But for the bonuses and the retirement benefit. So salary here would mean everything, but for bonus, PF, gratuity, and the retrenchment compensation. Getting my point? So here the salary defined under the Industrial Dispute Act is quite broad. The idea is to give more compensation to the disgruntled employee. Employee should get more amount, and therefore salary is kept on a higher side, which includes everything. It includes basic, DA, perquisite, allowances, but it does not include bonus, PF, gratuity, and the retrenchment compensation. Do you get this, friends? Everybody? So maximum exemption is 5 lakhs. Moving further. Sometimes, at times there could be retrenchment compensation which is paid to an employee because he's forcefully removed. But sometimes, an employee may voluntarily retire after a long period of service. There are changes in the organization and the employees are not able to cope up, or the organization has seen some serious engineering and therefore it want to cut down its workforce. That could happen, and therefore an employee can there could be a scheme of voluntary retirement which is introduced by the employer, and he wants to cut down on the workforce. Now what happens again? This is an identical situation wherein you cut the source. If you cut the source, you get some capital receipt. In lieu of the voluntary retirement, the employer is going to pay a lump sum amount. And once the lump sum amount is received in the hands of the employee, well, it is going to be taxed as salary. Now, if I were to tax it as salary, Well, it would be capital receipt which would be made taxable, and the employee would get a would have to part away with a large chunk in form of taxes, and therefore some exemption is provided. What is that exemption under section 1010C? Let's check out section 1010C. Prior to that, okay, question. Okay, Vaishali is asking, sir, एनपीएस में फाइनल अमाउंट इज टैक्सेबल और डिडक्टेबल? देखो, एनपीएस का जो फाइनल अमाउंट होता है ना एट द टाइम ऑफ विड्रॉल फ्रॉम एनपीएस, it is exempt under section 1012A, but not entirely. Only 60% of the withdrawal, commutation from the NPS is exempt. We'll discuss it while we discuss deductions under chapter 6A. Trishya is asking whether in retrenchment compensation DA is full. Yes, DA forming part of salary or not forming part of salary entirely would be, well, it is going to be considered for retrenchment compensation. Any amount paid, because it covers a long, yeah, the salary is broad enough. Definition of salary for the Industrial Disputes Act is broad. It covers allowances, it covers perquisites also. So that's the only area under the Income Tax Act wherein the definition of salary is so broad. All right, okay, it's 8:15. Let's take a short little break and then we start with voluntary retirement. Yes, Harnoor, I accede to your request. Let's take a short break of 5 minutes. Come back again. We discuss voluntary retirement and we discuss the very important funds, provident fund. The taxation of provident fund at times the students find it very complex, but it isn't. If you could just methodologically understand each of the type of the fund, you would not find it difficult at all. And this is also undergone the taxation of the provident fund or the other retirement funds, welfare funds, have undergone some change in the recent past. So Finance Act of 2021 have made a few changes, and that is where it becomes difficult from the examination point of view also probably, and therefore I've also taken up a few problems in respect of provident fund. We'll discuss those, and we take a short break of 10 minutes, 5 minutes, sorry, 5 minutes. We take a break of 5 minutes. Okay. All right, friends, welcome back. Let's move on to the scheme of voluntary retirement. We also call it as VRS, Voluntary Retirement Scheme, or the Golden Handshake, as it was called. Golden Handshake, wherein both the employer and the employee are happy, willingly decide to part ways with each other. This separation scheme is important from the employer's perspective because he wants to cut down on the total employment. He wants to increase his profitability. There have been changes in the organization, especially the public sector undertaking. What happens with them? They undergo a very serious re-engineering program, and therefore they want to cut down on their employees. If you in the recent past look at the PSUs, especially the banks, what has happened? A lot of PSU banks have merged into each other, and like say something like a State Bank of India. State Bank of India had so many different subsidiaries. Most of them have been merged with the parent organization. Now, what happens? Their employees would become employees of the State Bank of India, and it would be difficult for them to probably cope up in the organization. And therefore, there was a scheme that came in. Now, I'll just show you practically how it works. So there was a scheme that came in the year 2020, second innings TAP VRS 2020 by the State Bank of India. Now, what State Bank of India has offered to the employees? In order to optimize human resource, the objective of the voluntary retirement scheme is to optimize human resource cost. The total strength of the country's largest lenders or the largest bank stood at 2.5 lakh, 2.49 lakh employees as compared to 2.57 lakhs a year ago. Scheme will provide an exit option of a respectable exit route to the employees who are eligible. VRS employee would be open to all permanent officers and staff who are 25 years of service, 55 years of age on the cutoff date. The total saving to the bank would be 1,662 crores. 1,662 crores is what it is going to save. Now, once it is going to save this amount, government is also going to get more of tax. And therefore, I'm interested that yes, go for it. Lay off and optimize your organization, increase your profitability. I'm going to get more tax. Employees are going to get more money, and every stakeholder is happy. The bank would also get a deduction in respect of the amount they pay on such voluntary retirement. The compensation is deductible under section 35DA. This is something you will deal with while you discuss PGBP. You get whatever is paid as compensation for voluntary retirement to the employees is available as deduction in 5 equal installments under section 35DA. But this is something, we are not dealing with it right now. But this is a real scheme that happened. What Income Tax Act has to say? It says any amount received or receivable by an employee, any amount that is receivable by an employee from an employer, not being individual firm AOP BOI. So he is not an individual firm AOP or BOI, but is an institutional employer, right? So company or government, local authority, cooperative society, it could be anything, but not individual firm AOP BOI. On his voluntary retirement or termination of service in accordance with the scheme. Now, this scheme is framed under Rule 2BA. Rule 2BA of the income tax rules. You don't have to take any approval or anything for the scheme, but then the scheme got to follow some guidelines. What are the guidelines? You have got Rule 2BA. What it says, the scheme of VRS should be employee with minimum 10 years of service and 40 years of age alone should be given VRS. So the scheme should be wherein the employee has minimum work experience of 10 years in the organization and is of 40 years of age. applies to all employees except for directors. Directors are not covered by the voluntary retirement scheme. So it could happen that a particular director is an employee director. For him, the scheme is not applicable. It is applicable to all the other employees. It should result in an overall reduction of workforce. So that is another condition. You are removing a few employees, you are asking them to voluntarily retire, and you are again filling up the space. What is the point of then going for a voluntary retirement scheme? Then no recruitment for vacancies due to VRS. So whatever you have created the vacancies, that should lead to a overall reduction. And the employees who are retired, they should not be re-employed. That is fair enough, isn't it? So this is the scheme. What the scheme says, what the rule 2BA says, the scheme should be formulated in such a way that each of the employee who voluntarily retires should not get compensation exceeding. What is the maximum compensation that you're going to give? 1 3-month salary for each completed year of service, or equivalent salary at the time of retirement for the balance months of services left. So like one who has completed more year of service, he should get more the compensation. However, if the tenure that he is required to serve is very small, like somebody is retiring anyways, which is retiring 2 months or 3 months down the line, he is opting for voluntary retirement today. So maximum remuneration that you're going to pay him was only 2 or 3 months of salary. So that would be the amount of exemptions. 3 months salary for each completed year, or equivalent salary at the time of retirement of the balance service left. We're going to take this with an example, but for the time being, understand his 3 month salary for completed year of service or the balance service left, whichever is left. Now this whichever is less is contentious, but then, for the time being, let us understand this ways. Now, so any amount received by the employee from the employer on voluntary retirement in accordance with the scheme of separation, and the amount does not exceed 5 lakhs. So 3 conditions have been prescribed. Look at this. 1 is 3 month salary. 2 is for each completed year of service. 3 month salary for each completed year of service. 2, you've got to pay him for the balance period of service, or rupees 5 lakhs, or the actual voluntary retirement compensation received, whichever is less. Do you get this, friends? Everybody, voluntary retirement. You understand the meaning of it. That's all. So I've just shown you one of the schemes, a practical scheme of the State Bank of India, wherein, look at this, what they've done. They have said that all permanent officers of 25 years of service. So as against 10 years, they've prescribed 25 years. So higher is all right. And as against 40 years of age, they've prescribed for 55 years of age. So if it was 5 years of service and 35 years of age, well, that would not have been in accordance with 2BA, and then you lose out on the exemption. But here it is formulated in accordance with the rule 2BA, right? So I'll just take up an example and let's understand what this is all about. So just give me a second. Okay. So we have Mr. Darshan receiving voluntary retirement compensation of 7 lakhs. So how much has he received? He has received 7 lakh rupees of voluntary compensation. Now, maximum VRS compensation is, that could be claimed as exempt under 1010C is 5 lakhs. So at least 2 lakh rupees is going to be taxable. Going further, after 30 years, 4 months of service. So, he has undergone, Darshan has undergone 30 years of service. Now, 30 years would mean, 30 years and 4 months is 30 years, completed year of service. Now, we are not taking part thereof. He still has 6 years of service left. So 6 years of service would mean 6 into 12, that is 72 months. 72 months is remaining service. He has received 7 lakhs for 30 years of service. And therefore, for each of the year completed, I'll give him 3 months of salary. So 30 into 3 would be 90 months. So 90 or 72, right? Getting this, how 90 we worked out. For every completed year, you get 3 months salary as we are voluntary retirement compensation, or the balance service left. So balance service left is 72 months. 72 months is lesser than 90 months, and therefore we will have to go by 72 months, but maximum 5 lakhs. So at the time of voluntary retirement, he was drawing the following sum: basic 20,000 and dearness allowance 5,000. Right. So 5,000 and 20,000, his total salary was 25,000. You are required to compute the voluntary retirement compensation. So simple. Look at this, the solution. The solution is voluntary retirement compensation received 7 lakh rupees. Least of the following: specified limit 5 lakh rupees. For 90 months of salary into 25,000, he would have been eligible for 22 lakh 50,000. For the balance period left, that is 72 months multiplied by 25 months, he would have been eligible for 18 lakh rupees. What has he got? He has got 7 lakh rupees. So actually, or rupees 5 lakhs, whichever is less. So 5 lakhs is going to be less, and therefore balance 2 lakhs is going to be taxable. We get the two conditions: 3 months of service for each completed year and salary for the remaining months of service left. Yes, friends, simple. Have you got it? Any query relating to the voluntary retirement compensation? Now, there are a few miscellaneous points. One is, this is a one-time opportunity, once in lifetime exemption. Once you claim an exemption in any of the year in respect of voluntary retirement, you won't get it again. So even if you've claimed out of the 5 lakhs only 3 lakh rupees of exemption in the past, you are not going to claim it again. So that is what the proviso to this tendency, proviso 1 declares, that it is a once in lifetime exemption. It cannot be claimed again. So might be in problem you get that a particular employee receives 3 lakh rupees of voluntary retirement compensation. He has already claimed 1 lakh rupees from his previous employer. Gone. No further benefit under tendency. What he can though claim is a relief under section 89. That is something we are going to deal with in our subsequent lecture. Today we are not dealing with relief, but then either you claim relief under section 89(1) or you claim an exemption under tendency. You cannot claim both of it. Unlike in case of gratuity. Gratuity you can claim both of it. Then for the salary, for the purposes of this particular section, is your default salary, meaning salary plus DA forming part of retirement benefit plus the fixed percentage of commission that is received, right? So this is VRS compensation. Well, I have a few queries. Can you tell me why you took 3 months salary? Well, let me just take you through the provisions once more. And see here, you'll get why we took 3 months salary. The objective of the scheme is to compensate the employee. There are two ways to compensate. One is you give him salary for each completed year of service. They say 3 months salary for each completed year of service. Or you pay him for the balance tenure left, since you are kicking the person out, voluntarily, though, prior to his completion. Right. So what is the balance period left? Balance period left in this case was 72 months, and 3 months salary was 90 months. So I'll pay him for 72 months. Why would I pay him for 90 months? If he would have continued for the entire period, I would have paid him only for 90 months. 72 months, sorry. 72 months, and therefore I'm not paying the 3 months salary. I hope, Shana, you get the point. Yes, Darshan is asking whether can a person who who is opted for VRS get gratuity. The answer is yes. gratuity is also retirement. Voluntary retirement is also retirement, and therefore gratuity on retirement, he could claim as exemption under section 1010. Now, moving further, let's go to the funds. Let's go to the funds. Very important. See here, let's check out first the EPF, and then we go to superannuation. First, the EPF, the Employees Provident Fund. This is one piece of fund which is extensively used. Almost every employer, every organized employer is contributing some amount to the provident fund of the employees. So if a particular employer has got more than 20 employees, he'll have to ensure that there is a provident fund in place for the welfare of the employee, contribute to the fund, and the employee also contributes equally. Now, so what you have in the fund, what you have in the EPF, you have got contribution of your own, that is the employee contributes and the employer also contributes. So employer as well as the employee. Similarly, on both the contributions that the employer and the employee make, you will get interest, right? And at the end of the period, or at the end of the retirement, or on happening of some of the eligible events, the employee is going to get the benefit. Employee would get benefit of the entire fund. Of the entire fund, he's going to withdraw that money and he would utilize it the way he wants to. Now this withdrawal is ideally capital in nature, right? Because it is a one-time event that happens and you withdraw the entire amount from out of the fund. However, these funds are of different types. See, idea is that these welfare funds should be regulated. Meaning what? It should be under the control. It is for the benefit of the employees. The employer should not exploit this fund, isn't it? Just imagine there are, let's say, 5,000 employees working in an organization. Now they are all contributing salary, part of their salary into the fund. The employer is also contributing. Now, if that entire fund is with the employer himself, you know what the employer would do? He would take all the money and run away probably, right? And therefore, we don't want that to happen. Hence, these funds are regulated, and they say, you have to get a provident fund recognized. You got to, if an employer is maintaining provident fund for the welfare of the employee, he should get that fund recognized. Recognized with whom? So they say that recognize it with the, get approval from the Chief Commissioner of the Income Tax. Now I get that permission. How do I get the permission? There are a lot of conditions. You have a lot of conditions like it should, the employer got to form a trust and he should contribute on a particular day. The maximum contribution which the employer could make is, 12% of salary. This is something that we saw the other day when we were discussing the definition of the term salary and profit in lieu of salary. I did show you section 5, glimpse of section 5, which said, sorry, not section 5. It was section 7 that dealt with deemed receipts. So any provident fund contribution in excess of 12% of the salary was deemed to be received during the year and therefore was taxable as profit in lieu of salary or as salary. Now, therefore, there are set rules. The point is there are set rules for the provident fund, and if at all, the provident fund is maintained in accordance with the rules, the benefits of the fund would be given to both the employer as well as the employee. See, look here. Now, therefore, there are three kinds of funds broadly, as far as EPFs are concerned. There are three kinds of funds. One is the statutory fund maintained by the government. So this is something that is maintained by the government. Now, if it is maintained by the government, well, it is presumed that everything is in order, and therefore, whatever funds that you receive out of this statutory provident fund is going to be exempt. This is maintained by the government under the Provident Fund Act of 1925. The employer's contribution to this statutory fund is not income in the hands of the employee, right? See, ideally, employer's contribution is income, but then specifically exempted whatever contribution is done by the employer to the statutory provident fund, it is going to be exempt. Well, this statutory, I should add and I should let you know that this statutory provident fund is applicable only in case of government employees. So it is only the state government and the central government employee who are part of the statutory provident fund or the local authority. And therefore, employer is going to be government, state government, local authority. They are not going to act in contravention of the statutory provision, and therefore, whatever is contributed in the statutory provident fund is going to be exempt so far as it relates to the employer contribution. As far as the employee contribution to the fund is concerned, it is out of the disposable income. So it is already taxed, and therefore there should be no further tax on the employee's contribution. However, there is something called as Section 80C. This is something again you are going to see when you deal with Chapter 6A deduction. The employee's contribution is going to be deductible under Section 80C, subject to a limit of 1,50,000, overall limit of 1,50,000. You will see this when you discuss, Chapter 6A deduction. The interest amount which is credited to the fund. Now, interest, as far as interest is concerned, we saw with respect to contribution, anything in excess of 12% of salary is deemed to be received. So 12% of salary contribution by the employer exempt. About 12%, it is taxable and deemed as receipt in the hands of the employee. Similarly, as far as interest is concerned, 9.5% up to 9.5% is exempt. Beyond 9.5% is going to be taxable, deemed to be received. However, in case of statutory provident fund, these limits are not applicable. 12% and 9.5% is not applicable. The entire interest that is accrued on such contributions to the statutory provident fund is exempt, not income, right? And whatever is received at the end of the term, whatever the employee withdraws out of the provident fund is also exempt from tax under Section 10(11). So this fund remains entirely exempt during the continuation of employment, exempt post the continuation of the employment. At the time of withdrawal also, it remains exempt. So it is a triple E case: exempt, exempt, exempt. At the time of contribution, exempt. During the continuance of fund, exempt. And at the time of withdrawal, it is also exempt. Do you get statutory provident fund? Now, for non-governmental employees, you would have the contribution made by the employer to recognized provident fund. Now, recognized provident fund is one run by the government. EPF, you would have heard about the Employees Provident Fund program. Now, EPF is run by the government. It is already recognized, and therefore, you as an employer contribute directly to EPF. Or you have your own approved provident fund, like say a big industry like something like a Reliance or Tata. They can create their own fund because they've got so many employees, and they could invest those funds by taking the fund into trust, into different securities. And therefore, some of the employees, they run their own program, right, for the benefit of the employees. However, the condition there, if you're not contributing to the government fund, the EPF, you'll have to get your fund recognized by the CIT. The salary should not exceed, the contribution should not exceed 12% of the salary. So maximum contribution could be 12% of the salary. Salary here would mean again your standard definition, basic plus DA forming part of employment plus the commission at fixed percentage. Here there has been an amendment, and here now they say this employer contribution, we'll come to it in a short while, but this employer contribution, taking all the welfare contribution made by the employer, shall not exceed 7.5 lakhs. What is this? This we'll discuss in a short while, but do remember, whenever contribution is made to recognized provident fund, it shall not exceed 7.5 lakh rupees by the employer. So employer's contribution to a recognized provident fund, maximum exemption that you could get is 7.5 lakh rupees. Though even if the contribution is 12% of the salary, but if it exceeds 7.5 lakh rupees, it would be taxable. Now, whether deduction under section 80C would be available in respect of employee's contribution, the answer is yes. See, employee's contribution is one part of the story. There is an equal amount which is also contributed by the employee. Now, employee making an investment in EPF is deductible under section 80C, subject to a maximum of 1,50,000. Then, interest credited to Provident Fund. Now, interest credited to Provident Fund is not going to be my income until 9.5%. Beyond 9.5%, if I receive, let's say 12%, in that case, 12% minus 9.5%, which is 2.5%, would be my income. Now, this income is further divided. See, interest income is further divided into interest on employee's own contribution and interest on employer's contribution. See, are you getting my point? Interest would be segregated into two. One is interest on my own contribution. I'm an employee. Reliance is an employer, right? I contribute, let's say 1 lakh rupees. I'm going to get interest on 1 lakh rupees, and I'm also going to get interest on 1 lakh rupees contributed by the employer. Both the interest, if the amount, if it exceeds 9.5%, would be taxable. However, my own interest that I get on my own contribution would be taxable as income from other sources, right? Because it is not salary. My own contribution is not something related to employment. It is out of my disposable income, and therefore my own interest in excess of 9.5% would be taxable as income from other sources. However, the employer portion would be taxable as salary, right? So the amount that he contributes, about 12%, salary. The amount of interest that I receive above 9.5% would be again salary. So far it relates to the employer's contribution. Now, so that is interest credited. What about the lump sum payment? If I receive any lump sum payment at the time of retirement, it is mostly exempt, right? The only condition is that you should have a considerably long period of service. So usually, 5 years of service is considered to be long. So beyond 5 years, if you withdraw the amount, that is going to be exempt under section 10(12) of the Act. Yes, so that is recognized provident fund. Now, sometimes what could happen, usually it doesn't, but then sometimes it could happen that the employer does not get the provident fund recognized by the Commissioner of Income Tax. Now, if at all it is an unrecognized provident fund, friends, it is going to be unregulated, and we don't want that unregulated fund to exist. And therefore, both the employer as well as the employee got to be penalized for keeping the fund unrecognized, or for contributing to an unrecognized provident fund. However, this particular fund works on the EET mechanism. What is EET? EET is at the time of first contribution. At the time of contribution to the unrecognized provident fund, it remains exempt. At the time of continuance also, it remains exempt. During the continuance of the unrecognized provident fund, it remains exempt. However, at the time of withdrawal, no exemption is given in respect of this unrecognized provident fund. So unlike the recognized and the statutory, whenever you withdraw lump sum payment at the time of retirement or termination, it is exempt under section 10(11) and 10(12). However, in respect of unrecognized provident fund, well, friends, it is not going to be exempt, but it is going to be taxable. So it comes, brutally on the employee at the end of the period. So it might be exempt. So employee's contribution is neither income nor exempt during the continuance, but at the end of it, it is going to be taxable. The deduction under ATC is not available for unrecognized provident fund. Similarly, the employer making contribution is also expenditure for the employer. See, understand again. There is a contribution of the employer towards the welfare scheme of the employee. So it is an expenditure, for the employer. That expenditure is available as deduction from his profits. However, if he is contributing to unrecognized provident fund, even that deduction is not available. There are provisions contained in section 40 and 43B, which you will discuss at the time when you learn PGBP. But for the time being, understand ATC is also not available to the employee in respect of the employee's contribution. Similarly, interest credited to this unrecognized provident fund during the continuance, it is not going to be taxable. However, at the end, when you receive the lump sum amount, what you'll receive at the end of it, you'll receive your own contribution. Now, this own contribution would never be taxed, whether the fund is statutory, recognized or unrecognized, because your own contribution has already been subjected to tax. However, what would be taxed for an unrecognized provident fund? The entire employer's contribution, the interest amount received on your own contribution, and the interest amount received on the employer's contribution. As far as 1 and 3 is concerned, that is employer's contribution and interest received on employer's contribution, it would be taxed as salary. As far as interest is earned on own contribution, employee's own contribution, it would be taxed as income from other sources. So do you get this, friends? Everybody, employer's contribution and interest to be taxed as salary. Employee's share of interest would be taxed as income from other sources. I know it could be a little, difficult to understand, but then when you just read the provision again, when you just see the chart again, when you go through the lecture again, I'm sure you'll understand this. Keep one thing, very clear in your mind. Statutory provident fund, entirely exempt. Recognized provident fund, entirely exempt, so long as the contribution does not exceed 12% of salary, the employer's contribution, and the interest earned on all the contributions taken together. So whether it is the employee's contribution or the employer's contribution should not exceed 9.5%. If interest exceeds 9.5%, only the balance portion would be taxable. Now, how do you tax the balance portion? You segregate the balance portion of interest in two heads. One is income from other sources and the other is salaries. Excess interest earned on the employer's contribution is going to be taxed under salaries. However, excess interest earned on the employee's portion would be taxed as income from other sources. Yes. So with reference to the unrecognized provident fund, during the continuance of that fund, it is neither going to be exempt nor it is going to be taxable. We don't treat it. We don't give any treatment for contribution to recognized provident fund at the time of contribution or during the continuance of the unrecognized provident fund. But at the time of withdrawal from the unrecognized provident fund, we are going to tax everything except for the employee's contribution, because that has already been taxed. Yes. I hope, Rama, it's clear to you. Now, when it comes down to the RPF, recognized provident fund, it is exempt under section 10(12) if the employee has served for a continuous period of 5 years or more. 5 years or more, and thereafter he is going to withdraw from the provident fund, we are going to exempt it completely. But if he withdraws prior to 5 years, in that case, it becomes taxable. The employer's share would be taxable as salary, and the employee's share of interest would be taxable as income from other sources. But sometimes what happens, he leaves the employment prior to 5 years because of reasons beyond his control. Let's say the employee died and therefore the provident fund got to be withdrawn. In that case, it is beyond the control of the employee. Or let's say he becomes permanently disabled. It is beyond the control of the employee. Ill health. So by reason of that, if at all he withdraws, in that case, it is fine. Similarly, sometimes there is a change shift from the RPF scheme to the NPS. If at all it is transferred from one recognized provident fund to another recognized provident fund. Let's say there is an employee. Employee X is working with ICICI Bank. He has worked for 3 years. Now he wishes to move to HDFC Bank. What happens? He would transfer his money from one RPF, one recognized provident fund of ICICI Bank to another RPF of HDFC Bank. Now, this transfer is not going to be taxable even if it is below 5 years of time. Well, Harnur is asking a question that if an employee leaves the job, after a short period, will he get PF? The answer is yes, he'll get PF if at all he has contributed, if the employer has contributed. So how shorter a period could be? It could be, let's say, 6 months. Yet, if PF contribution is made, he'll get it. The only thing is, if the tenure of employment is less than 5 years, in that case, it would become taxable. Otherwise, it is going to be exempt. Okay. So let's move further. I'll have to just change my presentation. Okay. Before I change my presentation, just let us look at approved superannuation fund. I hope provident funds are clear. It could be a little difficult to understand sometimes. I've tried to give you a brief screenshot, with all the comparison. I am sure you'll find it useful. Just go through it once again. I'm there to answer all your questions. Don't worry. However, we just move to the next provision, that is approved superannuation fund. Now, what is superannuation? Superannuation is nothing but retirement along with pension. Not all employees retire with pension. Some of them, would retire before the age. They would leave the organization. And therefore, they are not going to get pension from this organization. But sometimes a person would work for a considerable long period of time and therefore he's going to retire on superannuation. Now, employer also keep such superannuation fund for the benefit of the employees. Under these superannuation funds, annuities are paid to the employees. So annual payment. Now, this also got to be approved. So like the recognized provident fund, superannuation fund should also be approved with the income tax department. The commissioner of income tax would grant approval and he would monitor that yes, everything is right with the superannuation fund. Any payment received from such superannuation fund on death of the beneficiary, right? So the employee dies and he gets some benefit. Well, that is going to be exempt under section 10(13) of the Act. Similarly, on commutation of annuity, you're going to get annual benefit, you commute it. If you commute it, it is again going to be exempt under section 10(13). See, commutation of pension is different from commutation of annuity. Annuity is annual payment. Pension is a periodical payment, right? So here it is annuity that you were supposed to receive from superannuation fund, you commute it. Now, if you commute it on retirement or incapacitation, it is exempt under section 10(13). Similarly, by way of refund of the contribution on death of the beneficiary, it is going to be exempt. Superannuation fund to the pension scheme. Transfer of fund from superannuation fund to pension scheme, which is recognized under section 80 CCD, would be again exempt, right? So that is superannuation fund in a nutshell. It again got to be approved. I've already told you. This fund is usually kept in a irrevocable trust. So like the RPF, recognized provident fund, you have an irrevocable trust. Similarly, here also you have an irrevocable trust and it is for the benefit of the employees who are located within the country, right? Remember, friends, employees' own contribution to all the funds, employees' own contribution. It is only the employer's contribution that could be taxed and not the employee's contribution. Employee's contribution is always exempt at the time of withdrawal because it has already undergone taxes. Now we move on to the very important 17(2)(v)(ii). This is undergone, this is a new insertion, relatively new insertion, and we got to consider this. I'll just change my presentation. You will have to bear with me for some time. It's the same thing, just that problems are contained in this presentation. Okay. We have already dealt with VRS. Okay. Yes, now is it visible, friends? 17(2)(v)ii and VIIA on the screen. Please, somebody confirm. I think it is visible to me. Now, see what happens. We are giving exemption as a government. What we are doing is we are giving an exemption for both the employers and the employees' contribution. Whatever contribution is done by the employer for the welfare of the employee, we are giving, we are exempting that provided it is made to statutory and recognized provident fund. But now what happens, this employee who is a rich employee, right, who is getting a lot of money, who, let's say, a CEO like Elon Musk, highest paid employee. Now look at the amount of contribution that would happen in his account. So 12% of salary of Elon Musk would be thousands of crores in terms of rupee. Now entirely, how can we exempt that thousands of crore? And therefore, government realized that we are granting exemption in respect of EPF to the extent of 12% of salary. But then the rich employees are getting a lot of exemption. We at one stage, we are trying to tax the rich. The highest maximum marginal rate for your year under consideration is more than 42%, right? And on the other hand, we are giving them huge amount of exemption in form of their contribution to recognized provident fund. And therefore, government came out with a new provision wherein they said that whenever the employer's contribution, see, mind you, it is the employer's contribution exceeds 7.5 lakh rupees. 7.5 lakh rupees to any other welfare fund. So a welfare fund could be your RPF, welfare fund could be your SPF, statutory provident fund. Welfare fund could be, the NPS, the National Pension Scheme. And welfare fund could be in form of the approved superannuation fund. If contributions made by the employer to any or all of these funds exceed 7.5 lakh rupees, during a particular year, the balance amount is going to be taxed in the hands of the employee, right? The balance amount over and above 7.5 lakh rupees. So maximum exemption that you're going to get is 7.5 lakh rupees. The balance amount we are going to tax in the hands of the employee. Now, fair enough, because 7.5 lakh rupees is a big chunk. Some of the employees were claiming an exemption of 20 lakh rupees. If the salary was 2 crore rupees, the contribution would be 20 lakh rupees. Or more than that, in fact. Now we don't have to give that amount of exemption, and therefore what we have done is we have restricted the amount to 7.5 lakhs. Let me show you the provisions of section 17(2) and 17(2)(v) and VII and 17(2)(v)(ii)A. Let's see what it deals with. Just give me a second. Go to the provision. And then we take up a problem. Where is it? Okay, yes, got it. So large contribution by employer. The aggregate amount of any contribution made to the account of the assessee by the employer in one recognized provident fund, two ATCCD, that is NPS, or three in approved superannuation fund, to the extent it exceeds 7.5 lakh rupees in the previous year, is treated as your perquisite or salary. Is treated as salary. Now understand here, friends. This is very simple provision. What you have to do is you just have to compute how much is the contribution. You come to know that 3 lakh rupees is the contribution to Provident Fund. 3 lakh rupees is the contribution to NPS. And Superannuation Fund, my employer has contributed 2 lakh rupees. So what is my total contribution? My total contribution is 8 lakh rupees. So how much is the taxable amount then? Taxable perquisite or taxable salary? See here, it is 7.5 lakh rupees for all the funds taken together. How much my employer has contributed? My employer has contributed 3 plus 3, 6 plus 2, 8. So what has he calculated in over and what has he contributed over and above 7.5 lakh rupees? It is only 50,000. Now this is very simple to calculate, and therefore you see what is so great about the provision. There is no complexity at all as far as the employer's contribution during the year is concerned. Very simple. More than 7.5 lakh rupees, taxable. However, there is a twist. The twist comes in form of VIIA. What VIIA says? Yes, let's check this out. VII says that accretion on large contribution by the employer to such funds would also be taxable. Now understand this. I have contributed 50,000 rupees extra over and above 7.5 lakh rupees. The amount of interest that I get on this 50,000 rupees, that is excess contribution, abnormal contribution, above 7.5 lakh rupees contribution, would be taxable. You know, my interest on recognized contribution to recognized provident fund and unrecognized provident fund is not taxable. We just dealt with it. If it is below 9.5%, well, we are not going up to 9.5%. We are not going to tax it. But if the contribution is abnormal in nature, I am going to tax the contribution as well as the interest earned on that contribution. So on this 50,000, whatever interest I am going to earn, I am also going to tax it. Now, fair enough. I say, okay, tax it. I know the interest rate and I compute the interest on this 50,000 for the year. It's fine. But what happens is for the subsequent year, this 50,000 rupees, interest on this 50,000 got to be computed, number one. Number two, in the subsequent year also, my contribution would be more than 7.5 lakh rupees. Say it is indeed more than 7.5 lakh rupees. So I got to compute interest on that amount also. So you have to compute interest on the abnormal contribution. We are calling it as abnormal. See, there is no such terminology under the Income Tax Act. What is abnormal contribution? Contribution about 7.5 lakh rupees. So we have to compute interest on abnormal contribution made during the year as well as for the past years, right? As well as for the past years. So that is important to be understood here. And that actually creates some problem as far as calculation is concerned. I'll just we'll just deal with this by way of an example. Once you understand the example, well, you'll understand the exact nature of the provision. See, we have got Noor Private Limited. We've got a small example here. Let's start small. Noor Private Limited contributed 8.5 lakh rupees during the previous year 22-23 towards recognized provident fund. What has Noor contributed? Noor contributed 8.5 lakh rupees. So what do you think is the perquisite under section 17 to VII? Instead of 7.5 lakh rupees, Noor Private Limited has contributed 8.5 lakh rupees to the RPF account of Rushita. Now, therefore, 1 lakh rupees is deducted. It has also made an she that is Rushita has also made an equal contribution. So what is my total contribution therefore? Total contribution of Rushita is going to be, the employer's contribution of 8.5 lakh rupees, and Rushita herself has contributed 8.5 lakh rupees. The total contribution, is 17 lakh rupees. My God. So now the interest would accrue on the entire 17 lakh rupees and not just on 8.5 lakh rupees or not just on 1 lakh rupees of balance. So let's move further therefore. So equal contributions have been made. Do you get 17 lakh rupees, friends? Yes. Everybody just confirm. Do you get this amount of 17 lakh rupees? Yes. And now the balance in her RPF account, as on 1st of April 22 is 32 lakh rupees. 32 lakh rupees is the balance in her RPF account as on the first day. So opening balance is how much? 32 lakhs. Now interest accrued on the RPF during the current year, during the current previous year, that is previous year 22-23, interest accrued on her RPF account is 3,44,250. Now what is asked? What is sought to be taxed under section 17 to VIIA? We are asking you not the amount taxable under VII, that is large contribution. You are already aware, a lot of you have already answered that what is taxable under VII is 1 lakh. So it's not any rocket science to compute that 1 lakh. However, computing interest on the excessive contribution above 7.5 lakh rupees is a tough job. Let's figure it out how you would compute that. Now, if you go by the formula that is given in the module, there is every chance that it would be confusing. Let me just show you, how we could just compute it using a few questions. Let's check it. See, my first question is, what is the amount of contribution above 7.5 lakh rupees? And you all have answered it as 1 lakh, isn't it? 1 lakh is something that you all have answered, and this is going to be taxed as perquisite. Now, I'm already given, that the total interest, just a second, that the total interest earned by Rushita during the year on PPF, on EPF account or the RPF account is 3,44,250. So what is the total interest? 3,44,250. On what amount have I earned this interest? See, on what amount? See, I've earned interest on the opening balance. Do you all agree? The opening balance of RPF is given to us at 32 lakhs. So I have earned interest on 32 lakhs. Similarly, I have made contributions during the year also. Do you all agree? During the year, I've made 17 lakh rupees of contribution. My contribution, that is Rushita's contribution plus Noor's contribution. Total 17 lakhs. Now, this 17 lakhs I have not made on the first day of the year. Similarly, I have not made the 17 lakhs of contribution at the end of the year. And therefore it was made periodically. Since it was made periodically, what I do is I take an average of it, right? So it is not 17 lakh rupees on the first day or the last day, and therefore, the interest that I earn would be on on the average of the contribution, isn't it? On the average of the contribution. I'll explain. I know it, a little too premature to explain this, but for the timing, understand 32 lakh rupees of opening, current year contribution of 17 lakhs, interest accrued of 3,44,250, and my closing balance therefore is 52,44,250. Do you agree with this? See, check this out. Three questions. Do you agree with this? Opening balance 32 lakhs, current year contribution 17 lakh, interest accrued 3,44,250, and therefore my closing contribution is 52,44,250. Now, the interest that I have earned of 3,44,250 is on the opening balance as well as accretion during the year. Now, the accretion during the year has occurred on a constant basis, usually on a constant basis. Therefore, is it safe to conclude that my investment in this fund is the average investment, which means the opening balance plus the closing balance divided by 2? So, in inventory management, you have seen this. The opening inventory plus the closing inventories divided by 2 is my average inventory. So similarly here, my total investment in the fund is the opening investment plus the closing investment divided by 2, which comes down to 42,22,125. Look at this, 32 lakhs plus 52,44,250 divided by 2 is 44,22,125. Now, what have I earned on this investment, on average investment of 42 lakhs? I have earned 3,44,000. And therefore, what is the rate of interest? The rate of interest is 3,44,250 divided by this average investment. So just calculate the rate. See, I hope you're getting it. If you don't get any other figures, do ask me. Now, what is the investment, the excess investment? See, what is the excess investment of the employer in the fund? What is the excess investment? You have already computed 1 lakh rupees is the excess investment. However, this 1 lakh rupees excess was also not invested on one particular day, but it was invested throughout the year. And therefore, what I do is I divide this excess investment by 2. Look, I have to compute interest, and therefore I'll have to compute the average investment. Had it been invested on the first day itself, well, in that case, it would have been 1 lakh rupees multiplied by 8.15%. Had it been invested on the last day only, in that case, I would have not earned any interest on this 1 lakh rupees. But since it was invested throughout the year, I take my average investment as 50,000, and 50,000, how it is computed? 1 lakh rupees of excess abnormal investment divided by 2. That is my abnormal average investment, which is 50,000. And 50,000 into 8.15%. That is nothing but my taxable perquisite. So my taxable perquisite is going to be 8.15%. How we have calculated the percentage? It is the total investment, total interest received by Rushita divided by the average of the investment made during the year, and that rate is multiplied by the excess or the abnormal investment, contribution made by the employer. So on the employer's contribution, my taxable perquisite on account of interest that I have received is 4,077, which is nothing but 50,000 multiplied by 8.15%. See, calculate this. See, how is see, interest is already given to us in the problem. The interest accrued on RPF is 3,44,250. This is already given. This is something that we have derived. 1 lakh rupees is something we have derived. This is already given. The opening balance is already given. We have calculated the closing balance. All right, 4075, 4077 due to rounding off. No problem. Good, great. So I hope you understood the rate and how we have computed this 17 to BIIA. Now this is, only for the current year. This interest taxable perquisite is also only for the current year. But what if, I have also made abnormal investment in the past? That past investment got to be accumulated and interest thereon also got to be computed to find out the taxable perquisite on that abnormal investment which I have made in the past, and we should tax it under this particular section, right? Getting this, friends, everybody? I know it could be a little difficult to understand, but then fairly logical. एकदम logical है. आपको क्या करना है ना, सिर्फ थोड़े से 2-3 प्रॉब्लम सॉल्व करने हैं. Once you solve a few problems, you'll get everything. Do not worry. See, I can take up one more problem if you want me to do it. Today I can take up one more problem. Let's say we have to give another 15 minutes. Are you ready for one more problem, or should we take some other provision and take a problem on this tomorrow? Or I mean, the day after tomorrow. I'll go by what you say. We'll take one last provision for the day, or we can take a problem on this. What do you want? You want to practice this on your own and then we discuss this again. And what I do is I take up leave encashment. Or you want me to complete this? We can take up a problem. I have got a problem ready. Let's go with a bit, majority, whatever you say. Should I take a problem? I've got a problem on this particular issue. We can complete the problem in next 15 minutes. Or alternatively, we can take up leave encashment. You can work out 17 to VIIA, from the module. Okay. All right. So we take up last provision, and what we'll do is we'll take up, if you require, we'll take up one more problem on this 17 to VIIA. But for the time being, leave encashment. Now, leave encashment is one unique concept wherein, what happens is employers generally give paid leaves, meaning even if the employee is on leave, he's going to be paid for it. So he's entitled to certain paid leaves. When such paid leaves are given, the employee would generally avail it. But if at all, it doesn't avail it. Say, for instance, he's a workaholic. He would not avail leaves. If he's not availing those leaves, what he can do is he can ask the employer to pay for those leaves, which he is not availed. He'll say, okay, you were anyways giving me leaves which were paid. Now I have not availed it. You pay me something more. And the employer would pay him for the leaves that he did not utilize. Now, if such payment happens during the continuance of my employment, this year I had an entitlement of 40 days of paid leave, out of which I have, consumed only 20 days. So remaining 20 days, I can encash during the year itself. Now, if I encash it during the continuance of employment, it is going to be taxable. There's no exemption for that. However, if I accumulate all such leaves, if I accumulate all the leaves that I have not utilized, unutilized leaves, and I encash it at the time of retirement. If I encash that at the time of retirement, only then would I be eligible for exemption under section 10AA. So leave encashment exempt under section 10AA if that encashment is done at the time of retirement. As far as central and state government employees are concerned, well, entire leave encashment at the time of retirement is going to be exempt. It does not matter whether your employee is a state government employee or another employee, if the encashment is done during the continuance of employment, it is always taxable. But if at all it is done at the time of retirement, central government and state government employee, all leave encashment entirely exempt. In respect of other employees though, exemption is subjected to a few conditions. One is the leave encashment received. Two, 3 lakh rupees, maximum 3 lakh rupees. Now this 3 lakh rupees have been, increased to 25 lakh rupees in the month of May only, 23rd May to the best of my recollection. There was a circular that came in which increased the limit of this 3 lakh to 25 lakh. But for your examination, the limit is 3 lakhs. For November 23, the limit is 3 lakhs. So amount of received from the employer by the employee on retirement, actual amount or rupees 3 lakhs, whichever is less, or 10 months average salary. So it could be, maximum leave that could be encashed would be for 10 months. 10 months of maximum leave encashment would be allowed as exempt. Or, so we have got another or cash equivalent of credit balance of earned leave at the time of retirement based on the entitlement of 30 days of average salary. 30 days of average salary for each completed year of service. Right? So maximum leave encashment would be 10 months or 30 days of average salary for each completed year of service. So 30 days for each completed year or 10 months. Let's take up an example and you'll understand this. It is very simple to understand. For the time being, it is either 10 months of salary or 30 days for each completed year of service. So maximum, when you compare it with 10 months, it could be 300 days, maximum 300 days, isn't it? Because 10 months would be 30 days, 300 days. But then for the time being, these are the 4 limits. Let's take it by way of a problem. You've got Bhumika, who's employed with Tata. She's employed with Tata Limited and she retires on 31st of November 2022. And she encashes. She would encash how much? She would encash 2,88,000. 2,88,000. See, she would encash 2,88,000. For 16 months of unavailed leave. Now 16 months would mean what? She has, she has withdrawn excessive and it is over in about 10 months. And therefore, I am going to tax something in case of Bhumika. What is that something? We'll come to it. So 16 months of unavailed. She had served for 20 years and 8 months. 20 years and 8 months, right? So completed years, 20. We are concerned with 30 days for each completed year of service, right? Then the 10 months average salary. Here we got to take average salary, right? We said 10 months of average salary, 30 days of average salary. Average salary for the purposes of Income Tax Act would mean, 10 months of average. So last 10 months of average salary is already given to us. So we will not compute this. 17,600 is already given to us, which is last 10 months of average salary. Now, they further say she was entitled to 1.5 months of leave for every completed year of service. So for every completed year, she got 1.5 months. So what was her leave entitlement? Can you tell me 20 into 1.5? This is the leave that Bhumika was entitled to. What is the total leave entitlement in case of Bhumika? Yes, friends. Total leave and entitlement? What is the total leave entitlement? It is 20 years of service, and as per the company policy, as per Tata's policy, she is getting 1.5 months. So 20 into 1.5 is equal to 30 months of leave entitlement. Yes, 30 months of leave entitlement. Out of the 30 months of entitlement, how much has she availed? Can you tell me how much has she availed? Out of the 30 months, how much has she availed? She has availed, it's given. She has an unavailed leave of 16 months, right? So in other words, she has availed 14 months, right? So I know now availed months, availed leave. This is something that I did not know, and I had to deduce it. Unavailed was 16 months. 30 months is the total entitlement, and therefore availed leave period is 14 months. Now, as per the Income Tax Act, they say that, employer can have any amount of entitlement. He can give 6 months of entitlement. We have nothing to do with it. We are going to give you only 30 days of entitlement. That is nothing but 1 month of entitlement, and not more than that. Right? We have what the Income Tax Act is going to give. The Income Tax Act would give you 20 months instead of 30 months. So the total entitlement would be 20 months. Out of which, you have already availed 14 months. And therefore, the balance remaining is only 6 months. So I should have got 6 months of earned leave. I should have got leave encashment for 6 months. How much have I got? I have got leave encashment for 16 months. So they say, 6 months or 16 months or 10 months, whichever is less. So 6 months would be lesser, right? Now I also know the average salary. So let's check it out. Actual leave encashment 2,88,000. See, I'll just take you through all the condition. Actual leave encashment. Or 10 months salary, 10 months of average salary. Per month salary is 17,600, and therefore 10 months of average salary would be 1,76,000. 1,76,000. Look at this. So 2,88,000 actual received, or 1,76,000, or 10 months of average salary, or 6 months of salary based on 30 days of entitlement for each completed year of service. So 6 months into 17,600. How much does it come out to be? 17,600 into 6 months. It would be 1,05,600. Right? Or rupees 3 lakhs. 3 lakhs is the maximum, but now it is 25 lakhs. Multifold increase. But then for your examination, 3 lakhs. Remember, don't take 25 lakhs over here. Then, therefore, least of the four is 1,05,000, and therefore C is the answer. See, are you getting it, everybody? Okay, Darshan, how is it 20 months? See, I'll just take you through the provision. The provision says you got to find out cash equivalent of credit balance of earned leave. So unutilized leave, you got to find out the cash equivalent based on maximum entitlement of 30 days. Her entitlement was 45 days. But as far as Income Tax Act is concerned, I got to compute her entitlement assuming that it was 30 days. So if it was 30 days, that means 1 month. For 20 years of service, she'd get 20 months of entitlement. She has already consumed 14 months of her leave. So balance is only 6 months of leave that she can encash, right? Or she can claim as exemption. So I hope you're getting it, friends. So leave encashment for you. Now, the next lecture, which is on Monday, we start with perquisites, right? And we would try to complete perquisite. And we have got another lecture for salaries. That day we'll do, we'll take some practical aspects, and we also take the relief under section 89. But for the time being, I hope you've got the retirement benefits. All the retirement benefits are over. Right? I'll be glad to answer any questions if you have got any. Wonderful. Nice to see you all engaged. A lot of you have answered the queries. It's a one-way traffic. Most of the times I don't understand how do you feel and how the lecture is going on. And it makes me a little nervous at the times, at some times where, and I don't know whether you are able to understand or not, but keep contributing, keep giving your suggestion, and I'll try to incorporate those. Thank you so much, friends. Let's take the next lecture on 19th. Good day. Have a nice day.